this session in the Countering Proliferation Financing webinar series. I'm Lucy Hendy, a Senior Manager in the AML CFT Supervision Division at the Isle of Man Financial Services Authority.
Hello, I'm Steph Christian. I'm a manager in the same division at the Authority.
And I'm Tristan Cayley, a Senior Manager in the same division.
The focus of this session is on entities in the financial services sector, including regulated firms and designated businesses, who are subject to the AML CFT code and supervised by the Authority. We have 4 objectives for this session. We'll start by looking at why CPF is relevant to you, particularly how supervised entities can be vulnerable to PF, and why it's important to identify and manage PF risks. Steph will then focus on procedures, controls and policies for you to put in place to manage PF risk. Tristan will then talk through a case study example to make this come to life and relatable to you and your business. And finally, we'll do a quick reminder of your reporting obligations relating to PF. I thought this quote from RUSI, the Royal United Services Institute, was a good place to start in demonstrating the role that supervised entities have to play in countering proliferation financing, or CPF. Proliferators need access to the private sector. That's where you and your firms come into the picture. As noted on the slide, governments and various authorities have a role to play in setting the regulatory and legal landscape to fight PF, but your cooperation is essential in the island having an effective CPF framework. Supervised entities are in a prime position to identify unusual or suspicious activity, which you'd then report in line with your obligations, and relevant authorities can act upon that intelligence. This shows how the private and public sectors must continue to work together to counter financial crime. It's also important to highlight that your business risk assessments covering ML, FT and PF give us as supervisors insight into the risks you face, and we can gain a comprehensive understanding at a national level of PF risk. This both supports our supervisory engagement at a firm and sector level, as well as the island's work on the National Risk Assessment. So why is CPF important to you? The Financial Action Task Force highlights that the Cayman Islands address this point directly. And we here on the island can draw relevance from this. We too are an international financial centre, with financial services accounting for a large proportion of our GDP. Our financial services sector also has a largely international customer base. As with the Cayman Islands, whilst there may be no evidence to suggest there are supervised island entities involved in PF directly, the exposure to PF is very real when you consider the international customer base and cross-border nature of many of the transactions undertaken. The FATF note that proliferation financiers are constantly finding new ways to evade sanctions, regardless of the geographical proximity to proliferating states, being the DPRK and Iran. They may target countries to route transactions or shipments through with weak AML, CFT and CPF controls in an attempt to go unnoticed, sometimes as far away as Africa and Europe. Therefore, it's not just connections to the DPRK and Iran that need to be considered. Many supervised entities on the island have connections to Africa and Europe, and I'm sure some of you can bring to mind immediately some customers who may be resident or conduct activities in those zones. The first step in any risk management process is identifying the risks. As supervised entities, you're used to constantly identifying new or emerging risks, whether they be money laundering, financial, reputational or environmental risks. Like these other risk types, PF risk concerns a number of factors and can be broken down into categories or risk buckets. Customers. This relates to customers and counterparties involved in a transaction or a business relationship. Are there individuals or entities potentially involved in PF? Have you been able to adequately identify and verify all relevant parties? Are the types of products or services your firm offers vulnerable to PF? Do the jurisdictions you as a firm operate in or with have adequate CPF controls? What about the jurisdictions your customers are resident in or undertake activity in? Transactions. This can be transactions as they relate to products, services or customers. Could a transaction for products involve dual-use goods? Is there the involvement of a potential shell company? Are the delivery channels of products and services, by both the firm and any of its customers, vulnerable to PF? And do they make commercial sense? Cyber threats. What is your exposure to hacking and ransomware? Do you have IT contractors who have access to sensitive information, and does that pose a risk? We'll now look at some of the indicators which may help you with identifying PF risk. There are many risk indicators which fall into the 6 categories we just talked about. Our aim is to highlight to you some of these indicators, but note that this isn't an exhaustive list. The sources on screen provide further information in detail, which may help you in identifying the PF risk your firm's exposed to. So here are some examples, and I'll talk through a few. Dual-use goods. One indicator of PF risk could be a customer dealing with dual-use goods for a seemingly legitimate reason, but they don't have the technical background that matches that, so it's incongruent with the intended activity they told you about. Structures may be complex for many legitimate reasons. However, it's a good way to obscure true ownership or control, particularly where several jurisdictions and entity types are involved, for example, trusts, companies, foundations or partnerships. Linked entities. Again, there may be legitimate reasons for this, but do transactions between linked entities make sense? Here we mean entities with, for example, the same ownership or controllers, management or address. Are the transactions in keeping with the expected activity? In the maritime and shipping industry, an indicator in this area could be the use of shipping companies, brokers or agents to get insurance or other financial services for maritime transport. And finally, jurisdictions. Those neighbouring or bordering Iran and the DPRK, or jurisdictions who are considered friendly with them, are really key to look out for. Jurisdictions with weak CPF frameworks or elevated risks of bribery and corruption may also be used to channel funds or transactions through. Steph's now going to talk through how you can manage these risks.
Thanks, Lucy. So how do you manage PF risk in your firm? The FATF recommends that firms should develop a clear understanding of contextual information and sources of PF risks that they are exposed to and take appropriate measures to mitigate them. Here are some examples of risk management that can be used to mitigate the PF risks in a firm. A PF risk assessment. Lucy has already touched on this earlier, but this can be incorporated into the money laundering and finance and terrorism BRA provided that the PF risks are considered separately. Where customers are legal entities, there needs to be consideration of wider structures, ownership chains, and any subsidiaries in the structure. Corporate governance. PF should be a regular consideration of the board and senior management in a firm, and included in the risk management and corporate governance framework. A firm's policies and procedures need to reflect and manage the risks identified by the PF risk assessment. Establishing controls. Screening is only one mechanism for sanctions compliance. Firms need to use other controls such as their customer risk assessments, customer due diligence, source of wealth, source of funds, transaction monitoring, understanding the beneficial ownership and reporting obligations to protect the firm. Due diligence is essential to understanding the customer and their activities to identify the risks. This includes understanding the transactions, the contracts, as well as the individuals. Firms must apply enhanced due diligence where higher risks are identified. Lastly, staff training. Training needs to enhance awareness and understanding of PF by using typologies to demonstrate how this is relevant to the staff and what to look out for through their day-to-day role. Tristan will talk through an example case study shortly. Lower risk firms which are small and serving predominantly locally based and lower risk customers are not expected to devote a significant amount of time and resources to risk mitigation. Therefore, the level of steps taken by each firm will depend on the type, size, and risk profile of the business. I will now hand over to Tristan.
Thank you, Steph. We're going to discuss at a high-level example which focuses on two regulated sectors, TCSPs and banks. The aim of this example is to talk through what considerations a firm should carry out, and it will link back to items discussed in previous slides. This example is using the same customer, a manufacturing company, developing and exporting satellite navigation parts. These goods could be considered dual-use goods, which therefore present an increased PF risk. The UK Department for Business and Trade defined dual-use goods as dual-use items, including software and technology, which can be used for both civil and military purposes. Now we're going to talk through and discuss the services the regulated firms are providing, and at a high level, the considerations each should be giving. The manufacturing company, an Isle of Man company, supplies parts and services to global firms, which include satellite navigation systems, specifically appropriate for avionics. Avionics in this context is aircraft and drones. Now the services. The trust and corporate service provider is providing the manufacturing company registered office services and professional officers, in this case directors. The bank is providing various bank accounts for the company and various foreign currency sub-accounts. Operational accounts pay invoices and parts for services, and there's a business current account. What is expected of these firms is the same level of consideration we place on money laundering and terrorist financing, but this example touches mainly on proliferation financing. So the trusting service provider, where a company is manufacturing goods, a firm should consider whether those products are considered dual use or requiring licensing by Customs and Excise. A TCSP providing director services of registered office are responsible for the company's compliance with all relevant laws and regulations. These products are considered to be higher vulnerability to be used for nefarious purposes, and therefore should be considered higher risk as part of the firm's PF considerations, and apply EDD on transactions following a risk-based approach. One example of EDD the firm may wish to use is the UK Department for International Trade's Goods Checker, which can assist firms in considering products and whether a PF risk is observed. For a bank will be in a position to monitor transactions of a company it provides services for. It's important for any customer that it understands the nature, scale, location, and complexity of its customer relationship. Where the relationship is introduced, e.g. through the TCSP, or generated organically, the bank should ensure that it has a full understanding of the manufacturing company's operation. Given the number of accounts, the rationale for each must be documented. The bank should recognise that these products being manufactured are considered to be higher vulnerability to be used for nefarious purposes, and therefore should be considered higher risk as part of the firm's PF considerations, and apply enhanced due diligence on transactions following a risk-based approach. Before we talk about the additional considerations, it's worth reminding that the Isle of Man follow the UK guidance. It is the policy of the Isle of Man government to maintain the laws relating to import and export of goods aligned to those in the UK. Guidance produced by the UK government in relation to export and trade controls are also applicable in the Isle of Man. Therefore, we can make use of some of the helpful tools published in the UK to assist in assessing PF risks. The following considerations are not an exhaustive list, but a good starting point in how we should evaluate PF risks. As mentioned a couple of times already, the UK Department for International Trade have a goods checker that can be utilised to check whether a certain product may pose a dual risk or require some form of export-import licensing. These could be indicators of higher PF risk depending on the product. This tool can help firms consider what, if any, EDD is required. This is particularly useful should a firm be unsure whether their customer presents PF risk, and this tool can then assist in considering what EDDs should be obtained around the nature, scale, location and complexity of your customer's activity. EDD is an important mechanism for firms to utilise where higher risk of PF is observed. Using the example in the previous slides, additional transaction monitoring could include requesting invoices for payments, both incoming and outgoing, made by the manufacturing company. This is a useful exercise to test that the customer's activity is in line with what is expected, or to get comfort where a transaction is presenting higher risk factors such as higher than usual value and or a jurisdictional risk. Ongoing monitoring such as adverse media screening and sanctions checking is useful to understand and carry out on an ongoing basis. The firm's procedures and controls should assist staff to consider when and what CDD and EDD should be gathered. It is important for the customer to understand and have the tools to determine any PF risks and whether a customer or their activity sits within the firm's risk appetite. Staff training should empower its people to recognise what factors present a higher risk of PF and what to do when those risks are observed. It should also include sanctions. It's important that firms fully document their consideration of PF risks and include relevant risk factors in their BRA and CRAs. Ultimately, when a firm has observed PF risk factors and are unable to satisfy that these risks do not present an unacceptable high risk, the firm should consider reporting this to a relevant competent authority. And Steph will now discuss in more detail.
Thanks, Tristan. The next video in this series will be presented by the Financial Intelligence Unit and will cover reporting obligations relating to PF. However, we thought it might be useful to briefly highlight your reporting obligations as a reminder. Where there is a suspicion of money laundering, terrorism offences or PF, a SAR must be made under Proceeds of Crime Act 2008 or the Anti-Terrorism and Crime Act 2003. Other disclosures are reports made to the FIU in relation to financial sanctions breaches or information provided to the FIU under Section 24 of the FIU Act. Further information can be found on the FIU's website shown on the screen. We'll close with sharing some useful links on CPF which you can take a look at in your own time. Thank you for joining us for this webinar, and if you have any feedback or queries on this video, please contact the AML CFT division on the details you can see on the screen.